Hey everybody, welcome to Screw the Stock Market. Aziz, how's it going?
Pretty good, pretty good. Had a very good conversation today with, well, this won't be his first time, but the second time joining the show. We had some technical difficulties the first time, so we were glad to be able to get him back. Brad Raschke. Am I pronouncing his last name right?
I think so.
There we
Hopefully.
go.
But yeah, it's kind of embarrassing. You know, we're kind of new at this whole podcasting thing, and we recorded for an hour and a half with him last time, and no sound. Or what was it? It was echo. So we couldn't use the episode. And then he thought that it was because he was a bad guest because he didn't. But he was an awesome guest, and
He's
now
a very informative, very, very informative guest. And we were very fortunate that he decided to grace us with his company once more and answer our 1,000,001 questions. But this is a good episode. It's all about how to become your own private bank, personal bank, something that you see flooded throughout TikTok and social media nowadays, but no one ever really provides you with real content about. Well, this was the real deal. This man talked about how to use life insurance policies to become your own personal bank and just be able to fund yourself in some ways tax-free even.
yeah, it's
Depending on how you
really,
structure it.
you know, I've heard about these whole life insurances, and even when I read the Dave Ramsey book about, he's not a fan of them because he says they're expensive and it's all going to the commissions and all this stuff. But since I read that book and since I've gotten into this whole world, I'm starting to think Dave Ramsey. I'm starting to disagree with more and more of the things that he's talking about because he's just so overly conservative and I don't know.
And we did address that during this particular conversation. So you get to hear how that's dealt with and get some more facts on that type of issue. So it's a good episode. It's a really good episode. It's very informative. We asked all the questions that we had burning in our brains. I hope we didn't wear out Brad, but he was, nice enough to answer everything and go into detail. So we really hope you enjoy it, and I hope you can get a lot out of it. And yeah,
enjoy the show. Thanks.
Yeah.
Hey there, thank you so much for tuning into the show. It means so much to me and Aziz that you are actually listening, that there's people really listening to the show. We're having fun with it, and we hope that you're getting a lot of value too. Education is just one of the first steps that anyone should take when they're on a journey towards financial freedom or personal development. And so it's great, you're doing the right things. I want to suggest a second step that you might want to consider if a lot of the things that we're talking about on the show are resonating with you. Consider visiting our website, legatoinvest.com/invest. And there's a button where you can click to gain access to our opportunities. And what will happen is you'll schedule a call with us. We'll talk, we'll get on a Zoom, and we'll get to know your investment experience. We'll get to know you. We'll learn about your objectives. And then if it's a good fit, we'll actually start to present you with real investment opportunities from time to time. And you'll be in the driver's seat where you can say, no, I don't like that one. And yes, I do like that one. And those real decisions, that means that you're actually in the game towards your financial freedom. So consider visiting legatoinvest.com/invest. Again, that's LEGADO invest.com/invest. Hey everyone, thanks for tuning in to Screw the Stock Market with Aziz and Alex. And we have our man Brad here with us. Brad, we're so happy to have you back on the show. Our audience won't know that this is the second time we've had you on the show because of technical difficulties, and I'm terribly sorry. But we're happy to have you back. We really wanted to because you have great information to share, and let's do it.
Yeah, thanks, guys. It's good to be back. Glad to be back a second time. Am I your second time guest?
I think we can, let's call it that. Yeah, you are the first second time guest. Absolutely.
All right, write it down.
So Brad, again, tell us a little bit about yourself, who you are and where you come from. And then later on, we'll talk a little bit more about your lessons for us and for our audience in investing.
Yeah, sure. I love it. I'm Brad Raschke. I am from Texas originally. I was born in Lubbock, raised in a little town in Central Texas called Brownwood. Came up in the food and beverage industry, and then went into insurance sales. Got in at Allstate doing home and auto, eventually wound up at a captive life and health agency. And now I own a brokerage with my best friend, Matt Ruddick. He's president and I'm vice president. We have about 35 agents in about 5 different states right now. We've grown this thing over the past 3 years. It's been phenomenal growth. We've been really happy with the way it's going. I married the love of my life 2 years ago, almost 3 years ago now.
Congratulations.
Name's Haley. Yeah, thanks. She was an Illinois girl, but she was down working in Texas. So I was swiping Bumble on my parents' back porch one Thanksgiving and matched with Haley. Literally thought she was a bot, because you know how many bots are on those dating. Yeah. She had really beautiful pictures. She was super photogenic. I said, "Oh, this is a scam." And so I made a really inappropriate one-liner to lead with. Yeah, it was bad. Almost blew it on the first shot. But then, I redeemed myself, went out on a first date with her, and the rest was history. Now, we live up in Illinois, really close to her parents. We live about 15 minutes away from her parents, and here at our Key Retirement Solutions home office in Geneva, Illinois, is where I sit right now. We had a son last year, almost 2 years ago now. His name's Declan Mack. That's about it.
You got to be a charmer if you were able to redeem yourself.
It was bad. I dug myself a big hole. Yeah. That's the story in and of itself.
I'm willing to bet that the fact that you did that might have actually worked in your favor if it got her attention, right? If it's like, what? Like, and now you're having a conversation. Now you're memorable. There might be some marketing lessons. We might have you back for a third time. Talk about marketing.
I would not recommend anyone do that. It almost backfired. Almost didn't go on that first date for sure. So to kind of what we're going to talk about today,
sure.
In the midst of all that kind of insurance experience over the past 7 years, I found the infinite banking concept, and that was through an economist named Robert Murphy. Your last guest, tell me his name again, Aziz.
Curtis May.
Curtis May. Curtis May mentioned Austrian economics and how he studied that. Well, I was studying that too. I started studying Austrian economics my senior year of college, and I was a U.S. history major, but economics just goes hand in glove with history. And so I started studying Austrian economics, read a lot of the same books Curtis May mentioned, a lot of Bastiat, Henry Hazlitt, Murray Rothbard, Louis von Mises, eventually wound up at a modern day economist named Robert Murphy. Started listening to Robert Murphy, and he talked about this podcast he had called the Laura Murphy Report. Started listening to that. They were talking about infinite banking. I was intrigued. I was into insurance. You use insurance products to achieve becoming your own banker and practicing the infinite banking concept. And so I dove in there. And now I've graduated from the Nelson Nash Institute, mentored under James Nethery for a year, and now I'm out on my own practicing infinite banking with my clients. So yeah.
How beautiful. So I guess that's another thing too that I'd be interested in talking to you about a little bit is this education system or I guess education system that's giving you kind of the confidence to go out into the world and really start to help people. Because, a lot of the things that we talk about on the show require some experience, require some learning, and require some of that. And so could you tell us a little bit more about, I used to study a martial art called Aikido, and they're really big on lineage of like, I learned it from this master, who learned it from that master, who learned it from the founder, and so it sounds almost similar to me in the way that you're talking about. It
really is. Nelson Nash wrote the book Becoming Your Own Banker back in 2001. And the book is a synthesis of seminars he had been doing for 21 years. Since the early 80s, he had been doing seminars on using dividend-paying whole life insurance policies more like a bank account as an asset that you can leverage against rather than for the death benefit. The death benefit's important, and it's definitely still a part of the life insurance policy, but Nelson figured out that these dividend-paying whole life insurance policies can actually function like a savings account, like an asset much better than it does a life insurance policy. So he started using it to leverage and in his personal finances, and he taught that to other people for 20 years, wrote a book in 2001. About 2012-ish, the Nelson Nash Institute came along. That was a product of Robert Murphy, Carlos Laura, David Stearns, who is Nelson Nash's son-in-law, and Nelson Nash himself. They put together coursework. So you do about 3 to 6 months worth of coursework, depends on how fast you get through it. And then you take a final exit exam. You have to score above a 90 on the final exit exam. And then you get paired up with a mentor. My mentor, I was really fortunate, was James Nethery, who is the foremost practitioner, infinite banking practitioner in the United States. He was the first mentee of Nelson Nash himself. So Nelson Nash hadn't taught any insurance agents about the infinite banking concept. He just taught clients. And James Nethery happened to go to one of Nelson's seminars and said, hey, you got to teach me this, and talked with Nelson, got Nelson to teach him. And then I was paired up with James. So yeah, it would be like in jujitsu if I was trained by Hoist Gracie. It's like Hoist was trained by his dad, who was trained by his grandpa. And it's just that direct lineage.
That's cool.
Awesome. Yeah. So can you kind of go into it and explain like the process overall and what are the benefits of it?
Yeah. I think the best way, I've been thinking about this because I knew this question was coming. I think the best way for your audience maybe to think about it is a mortgage, right? Everyone's in real estate. Everyone understands how a mortgage works, right? Mortgage, amortized loan, you make payments, make monthly payments towards your loan, and you gain equity in your house, right? So imagine this mortgage, we'll call it the miracle mortgage. I'm stealing that from my buddy Ryan Griggs's blog. If you want to look him up on Medium, Ryan Griggs, the miracle mortgage. Imagine this mortgage where as you paid your monthly payments, you increased your equity, and the value of your home was guaranteed to never decrease. There could be no market fluctuations in the price of your home. And in fact, every time you made a loan repayment, you saw your equity steadily increase. Okay. Now imagine also that you wanted to make an improvement on the home. Maybe you add an extra bedroom. So you go from a 2 and 2 to a 3-2. Well, no matter what you do to the house, whether it's add a pool, whether it's add a second story, whether it's put shutters on the outside, any improvement you make to your house also increases your equity. So you can't screw it up, right? Also, this mortgage company that you're taking this loan through allows you to take out a second mortgage or to cash out refinance anytime you want. Or a HELOC, I guess, would be a more appropriate term. You can take a HELOC against your rental house anytime you want. But for the HELOC, the interest rates are locked between 0 and 8%. And there's actually no loan repayment schedule. In fact, you never have to pay back the loan if you don't want to. As long as your principal plus interest don't exceed your equity stake, you could float that HELOC loan forever, right? Also, you could take out this loan and reinvest it into your property, further increasing your equity stake, further increasing the market value. That's how dividend paying whole life insurance works. Oh, not to mention your mortgage company is mutually owned. So every time that you faithfully pay your monthly mortgage payments, at the end of the year, if the mortgage company is profitable, they give you a dividend on the back end.
Wow.
Yeah. So that'd be pretty cool, right? It unfortunately does not exist in the mortgage world, but it does exist in the insurance world. It's dividend paying whole life. So there are these life insurance policies where you can make payments, make monthly premiums, and your equity stake or your cash value increases over time. You can leverage against that equity in the form of a loan at any time you want. There is no loan repayment schedule. You get to determine when and if you repay it. The company that your insurance is with is mutually owned. So when the company's profitable, you get a dividend at the end of the year. And you can take that dividend and buy more death benefit or reinvest your dividend back into your insurance policy. So you can get compounding interest on your loan.
Now, the question I think most people have is that if you're taking a loan out on this policy, are there interest payments that you have to, at some point or whenever, if you decide to repay it, have to pay back, or is there no interest?
There is interest.
Okay.
Yes. So theoretically, you never have to pay it back, right? You could float a loan forever as long as your principal plus interest don't exceed your equity stake or your cash value, right?
And the second you exceed that, they'll just cap you and said you can't borrow anymore until you pay back what you've already borrowed.
They'll call the contract.
Okay.
And then the contract will be canceled. The debt will be wiped, but your death benefit no longer exists. The whole contract is just wiped. Yeah.
Okay. So technically you can have the option of never paying it back at all, ever. But you just risk the chance of, losing your death benefit permanently.
You could. That's correct.
Okay.
You lose the death benefit, you interrupt that compounding interest curve that you have going. Because another feature of some companies called non-direct recognition companies is that you can take a loan and earn interest on your full equity stake, even with an outstanding loan. So if you have $10,000 worth of cash value and you take a $5,000 loan and it comes time for them to credit you with dividends at the end of the year, you get credited on your full $10,000 stake, even with the $5,000 outstanding loan. Those interest payments that you were asking about, Aziz, go to the mutually owned company. Absolutely. But then it's contributing to the profitability of a company that you're part owner of. So then those dividends come back to you indirectly. Yeah, your interest comes back to you indirectly in the form of a dividend.
Got it. And normally, what are the dividend rates? Does it vary by company, or is there normally like an industry set rate?
Definitely varies by company. The company that I use the most right now, I don't endorse any one company because things are always changing. Contracts are always changing. The way these policies are structured is always changing. But last year, 5.1% was the dividend. And in higher interest rates and environments, insurance companies pay higher dividends. So if we continue to see the federal funds rate go up, we will see higher dividends from the insurance companies.
Now, are dividends paid on an annual basis or monthly, bi-monthly? What's the normal payment schedule?
Yeah, great question. It's paid annually.
Okay.
On the policy anniversary, your policy gets credited with dividends based on your cash value.
Now, before we get much further into the weeds on the flexibility and all the benefits here, one of the things that I've always really struggled with is just where does this inherent value come from, right? Like, we're giving them money. Why is, again, I'm very limited in my thinking about insurance as just, hey, when I die, they're going to pay me some money. Can you explain that? Like, where is this value coming from? It's just confusing.
Yeah, I love that question. Not a lot of people, I listen to a lot of podcasts on infinite banking and read a lot of articles. Not a lot of people ask that question. That's a great question. The value, the cash value, is the net present value of the future death benefit. Okay, so there's this future cash flow that the insurance company's on the hook for. It might be $1 million death benefit at the time you're 83 or whatever natural mortality is, right? And the company knows, hey, we are going to have to pay that out into the future, but we're going to collect premiums until Alex passes away at 83. So today, what we'll do is we'll set a buyout, basically. We'll give Alex this offer. Hey, we'll buy you out of your $1 million death benefit for $50,000 today. And you could take that deal, Alex. Your cash value is a feature of the contract that you could completely cash out, take, and walk away with. Okay. But they also give you the option to take a loan against that cash value. And that's the best way to do it, because then you earn the uninterrupted compounding interest from the dividends being credited regardless of outstanding loans. So the cash value is a function of the future death benefit, of the future cash flow.
So they would prefer if you actually cashed out early. I mean, that saves them money in the long run, which is why they make it so flexible.
Well, it's kind of like a buy and hold property.
Yeah.
right? They like the cash flow. They like knowing that you're going to pay a monthly or annual premium payment.
Right.
And so that cash flow is a plus for them. And the way their actuaries work it out, the way that the smart math nerds work it out is as long as they get those cash flows every single month, they're going to be whole by the time they have to pay out that death benefit. They're going to be in the black. So, yeah, I see why you would think that they want you to buy out, but they like the cash flow, just like any landlord likes the cash flow.
Very interesting. Okay. So now I think I understand the value. I like the idea, net present value. I understand that it's worth, what is it? Worth less today or worth more today than it will be later. Okay. So
yeah, it's like, I like to use the analogy if I were to place a bet on the Chiefs to win the Super Bowl this year, right? But I could get maybe 20-1 odds, right, for the Chiefs to win the Super Bowl. And so I place a $100 bet. So I have a $2,000 future debt that a casino might pay me out, right? Well, if the Chiefs are 8-0, 8 games into the season, that casino might come to me and say, "Hey, we'll buy you out for $300 on your $2,000 ticket." And I'm like, "No, I'm feeling pretty good about this, right? I'll keep it." And then, 10 games in the season, 12 games in the season, playoffs come along and they're undefeated rolling into the playoffs. And then the casino comes to me and says, "Hey, the net present value of that ticket now is $1,200. We'll give you $1,200 for that $2,000 payout." I'm like, "No, I'll hold on to it," right? And then all of a sudden the Chiefs are in the Super Bowl and the casino comes to me and they go, "Okay, we'll buy you out for $1,900. And I'm like, "Okay, that's worth it, right? I'll take the buyout." So that's the concept of net present value. The closer that we get to the inevitability of that ticket paying out, of that bet paying off, the more and more that casino is willing to pay me. Same thing with your life insurance policy. The closer and closer you get to natural mortality, the higher and higher your cash value will be. So this isn't a function of an investment. There isn't some side fund that your money is put in and indexed to the market. This is an actual function of the contract. It's within the nature of the contract for the value to grow over time.
Now, the dividend is basically based on that contract value. Or is there a way that they calculate how much of that percentage will be each year?
Yeah, the percentage is calculated from the profitability of the company.
The overall company, not in
Correct.
terms of your return or how well your contract is doing or anything in that regards.
Correct. There's a couple things that go into it. One is less people die than they thought they would. So they pay out less death claims. Two is they do have underlying investments. Insurance companies do have investment portfolios, and you can look into those. They're typically super safe. It's commercial real estate and stuff like that, bonds. And then also, oh shit, I lost my train of thought here.
We'll pause that in the recording. All good. So what was it? It's less people dying.
Less people dying. What is the third thing? Less people dying. Profits.
Maybe more sales?
Yeah. The third thing is a function of people living longer. The mortality tables just being underestimated, right? When my parents bought insurance back in the 80s, natural mortality might have been calculated at 78, 79. And now it's calculated at 88, 89. That's a little high, but you get the gist. So the mortality tables could be a little off.
Okay.
Now, one question I had is, in terms of the usability of the insurance plans as like investment vehicles or, as a, revenue source that you can kind of pull from, it seems that it favors those that are already further along in the process than those that are kind of early on starting out. So, if you're just now starting your life insurance policy, it's not as beneficial as being a bank for you, as opposed to someone that's already been contributing 20 or 30 years into a policy. or unless you're someone who just kind of is pretty wealthy to start off with and just drops a ton of cash into the policy right off the bat. So how can people that are just getting started kind of leverage this to make it useful for them?
Great question. Yes, you're right. People that have been doing this longer do have more access to capital. They've been capitalizing their system for longer. They've made more mortgage payments. They have more equity. But the way that these policies are structured, if they're structured correctly, there will be significant cash value there year one. So here's a small example, right? I have a policy. You could get a policy that is $3,000 annual premium, right? Just small policy to start out. There's going to be $1,500 in cash value there year one. So what you can do is take a loan from your policy to go buy your Christmas presents, right? Normally, people would either put it on layaway and pay Walmart interest, or they would pay cash. If they pay cash, then they never earn interest on that money, right? They're trading cash for goods. But if you take that cash and you pay an insurance premium first, you start an uninterrupted compounding interest curve on that money. So here's an example. My wife wanted a camera for Christmas, and so I went and spent $850 on a camera. I was charged interest on that loan, let's call it 5%. So I paid about $893 for that camera total. $43 went to the insurance company for interest payments, and $850 went to repay that loan in my insurance policy. Now, if I just would have gone and paid cash, then I would have had a camera, right? But now that I've paid a premium first, taken a loan, bought the camera, and then paid it back, I'm going to have a camera. And then over the next 50 years, that $850 with compounding interest, 5%, over the next 50 years, that's going to turn into over $10,000 of capital that I have access to. So even if you just have a small policy, you can do stuff like that to constantly keep money flowing through your insurance policy. Because sometimes it's not necessarily about the return on your investment immediately, but it's about the velocity of money, right? How quickly can I get my money in my hands and back out, in my hands and back out? You hear them talk about it all the time on Shark Tank. When can I expect an ROI? When can I expect my investment to be made whole, right? They want to know that date. Why? Because they want to take that money and invest it in something else. It's the same concept in the insurance policy. Put that $850 in, get it out to buy a camera, get it back in as quickly as possible, get it out again, get it back in as quickly as possible, get it out again, etc. Rinse and repeat. Add velocity to your money. All the while, it's earning 5% dividends.
So every time you borrow against the policy, that increases your net earnings on the policy on the back end?
Correct.
That part is still not very clear. How does that exactly work?
Because every loan is going to be charged interest.
Okay.
And that interest is going to go to the insurance company. And then that's going to get kicked back to you in the form of a dividend at the end of the year.
Got it.
The more loans you take, the more velocity you put on your money, the more profitable that mutually owned company is that has your policy.
Got it.
Yeah, so that's really interesting. So that example of the camera is one because it's money you were going to spend anyway. But now you're saying when we talk about velocity of money, we're talking about putting it in things that will pay us, right?
Correct.
So now you could put it into, I don't know, some other type of investment where it pays for itself. And now you're really talking about more exponential type of velocity of money.
That's right.
And it really changes the mindset because then now you're thinking of the company as your personal company.
Yes.
Because you're trying to make the company more successful so that you can get a bigger dividend at the end of the year or, progressively through time.
Yeah, that's an awesome insight. Definitely. It's an easier pill to swallow making a loan repayment to my own insurance policy, to my own insurance company, than it is to Discover or American Express.
it's kind of funny. Normally, you don't think about trying to make more money for a company, but
When you're a part
It's
owner,
very
you do.
strange.
Yeah.
Yeah.
yeah,
Okay, so here's another caveat we can add in also. You put in non-qualified money, post-tax money. You have to pay insurance premiums with post-tax money. As long as you pay with post-tax money and you respect this one IRS rule called the modified endowment contract rule. I help my clients with that. I make sure that they respect that IRS rule. As long as you do those two things, pay with post-tax dollars, respect the modified endowment contract rule, your money grows tax-free, loans are tax-free, and the death benefit is tax-free. And when you take a loan, if you're an investor, you take a personal loan out of your insurance policy and loan that to your LLC. And then you charge your LLC the 4.5% interest. The LLC is going to write off 100% of that 4.5% interest and pay it back to you. So it's a wash loan for you personally, and your
wow.
LLC is writing that off. So
Oh, that's
now
good.
think about putting velocity on your money and constantly churning that money through your LLC again and again and again. Your LLC is going to write all that off, and it's all profit to your mutually owned insurance company.
So you're never paying the interest.
Not your LLC would. Yeah, your renters would.
That's amazing.
Yeah. So another thing, whenever you're calculating, just like accounting math, right? You only count cost of capitalization once, right? So I have a friend in Texas who flips about 4 houses a year, and he's doing about $250,000 flips right now. So he has capitalized his system. He has $250,000 in his bank. So now what he can do is 4 times a year, he can put velocity on that money, cycle that through his policy, and write off all of that interest from his LLC and create huge profits for the insurance company that would come back to him in the form of a dividend.
Very interesting.
Yeah. Or you could do it with $800 cameras, just a matter of scale.
No, that's awesome. I mean,
Yeah.
that it's pretty much a free loan, and
Yeah.
you're giving yourself a dividend on the back end. That's really good.
If you have a cash flowing business to loan the money to,
Yeah.
if you have a cash flow positive business or a rental property or something to loan the money to, then yeah, absolutely, it's a wash loan for you personally every single time. The business is writing it off, and and your dividends are going to grow.
Awesome.
Yep.
Very exciting. So what else? Okay, so now we're talking. So we have this cash value, and then the biggest key is to borrow from that cash value, use velocity of money, and find creative ways to use that money. And now we're not just making money off of the money that we borrowed, but then just the structure itself is benefiting us. What are some other examples that or other benefits that we should be aware of as we start to think about doing this? And
Yeah.
what have you
No, I
seen
got
in
your
your
question.
clients? Yeah.
Yeah, for sure. Number one is capital attracts opportunity. Opportunity will hunt you down. Nelson Nash used to say, opportunity will hunt you down if you have access to capital. So you don't constantly have to have your money in velocity, right? Just the fact that you have a pool of capital sitting there will open your eyes to opportunities that didn't previously exist, right? Why do multimillionaires have private cell phone numbers that they change if it ever gets made public? Well, because people are always calling them, asking them to invest in this, invest in that, right? We see professional football players who own like 4 car washes and they go bust, right? The Andre Rison story. If y'all saw the 30 for 30 broke. Capital attracts opportunity. So one benefit is just having access is going to bring more opportunity to your doorstep. Another thing is you don't always have to churn money through an LLC or an S corp, right? You could just do it for personal purchases. What do you do whenever you need a large purchase, like a $50,000 car? You take $5,000, maybe $10,000, and you put that down on the car, and then you finance the rest through the bank, right? And what you might have a 1.9% rate, or you might have a 0.09 or a 0.9% APR on that note. The interest that you're losing to someone else's bank on that note by volume is something like 23 to 24% of the whole car. So even though your APR might be like 1.9 or 2.9, by volume, you're paying like 20% interest on that car. Same thing on a house. Think about a $200,000 house financed at 4.25% for 30 years. By volume, you're going to pay almost 100% interest on that house, right? Your total purchase price over 30 years is going to be something like $390,000 on a $200,000 house. So you're paying 95% interest by volume. So the average American loses 34.5 cents out of every dollar by volume to interest payments. I don't care what their APRs are. By volume, they're losing 34.5 cents. So if you start financing those purchases instead through your own bank and recapturing that lost interest into your own banking system, you're traveling or you're saving and accumulating wealth, if it's 34.5 cents, 690 times faster than someone who's not practicing being their own banker. Does that make sense?
That makes a lot of sense.
Yeah. Nelson uses an analogy in his book, Becoming Your Own Banker, of flying a plane. And he says, if you fly a plane into a 345 mile an hour headwind at 100 miles an hour, if your ground speed on the plane is 100 miles an hour, you're flying into a 345 mile an hour headwind, you're actually moving backwards, right? But if you fly with no wind, you're just moving at 100 miles an hour. But if you wait until you get a tailwind behind you to fly, then you're going to move at 690 miles an hour. Your ground speed is 690 miles an hour, or 345 miles an hour. So you're flying 690 miles an hour faster than someone who's flying into a headwind. Those people who are taking those low APR loans from banks and financing all their purchases through Bank of America or Chase or Wells Fargo or Fannie Mae or Freddie Mac are losing 34.5 cents on every dollar. If you just take the time to capitalize your system so that you can finance those purchases yourself, then you can grow your wealth 6.9 times faster, almost 7 times faster than they will, just by practicing being your own banker. That's the biggest thing. That, to me, that's huge.
That is, yeah. Agreed.
I was going to say, because like a lot of the things that we talk about on the show are always, it's a show about investing and growing our wealth and things like that. And so I think a lot of the time we disregard the personal expenses that we all have. We all have to live our lives, and we all have mortgages and car payments and gas and food and all that stuff. And that budgeting component is a very real part of it that we all have to kind of cover and then some to be able to even invest, right? And so I think that's really a powerful idea, to be able to help us with even those expenses before we even start thinking about investing and growing wealth. That's really powerful.
Yeah. Curtis May hit on it a little bit. Practicing becoming your own banker, using dividend paying whole life to create your own personal bank. It is not investing. It is capitalization. It is capitalizing an asset that you can leverage against down the road. You can't think of this as an investment, because as soon as you do, you're going to compare it to the interest rate of your portfolio, right? And if your portfolio gets 13% this year and your dividends on your policy are 5%, that is going to look like a paltry return, right? A minimal return compared to your portfolio. And so then what do? You start directing dollars away from your insurance policy into your portfolio. But what you're forgetting about in that scenario is the power of leverage. The fact that you can leverage against that insurance policy without ever interrupting the compounding interest to go make those purchases.
Very exciting. Now, I have one personal one, right? Like, the most money I've ever seen in my bank account was right after I sold my house.
Mhm.
It's a lot easier than saving to just all of a sudden sell a house, boom, there's a bunch of money in the bank. And if for me, okay, I sold the house and then I meet Brad and I'm sold, hey, I wanna do this. Is there a way to, through lump sum payments, maybe skip a few of those years of making little by little payments to be able to get to some of those, get to the point where there is more value in
Mhm.
my account? How could that work?
Yeah, policy structure is what you're talking about. How do we get the money into the policy as efficiently, as quickly as possible? Is that
I think so. Yeah. I think, again, going back to Aziz's question about how, I mean, you already said there is value almost right away,
Mhm.
but there's more value if you could skip some of those years.
Yeah,
And if I
Like
did
dumping
happen to be,
I got it. A
yeah,
dump
like
in.
dumping like a huge amount of money in at the front,
Mhm.
like let's say like 50,000, or even if you got it 100,000 right off the bat, will that get you a little bit more, money to play with down the line?
Absolutely. Yes, absolutely. And your break-even points, are sped up a little bit too.
Yeah. So you
Um,
can do that.
yep. Yeah, you have to be careful because we still have to respect those IRS rules. And part of those IRS rules have to do with how quickly we get the money into the policy. Uh, I don't want to go down that rabbit hole, but basically, probably in the scenario you're talking about, Alex, we would string out those payments over 2 to 3 years. So if you had $100,000 in the bank, we might do $30,000 for 3 years, and then we might drop that down to maybe $7,000 to $10,000 a year ongoing after that.
Mhm.
So that's going to give you a big chunk of money in those first 3 years to mess with, and then manageable ongoing payments after that.
Is there a hard limit on the amount that you can drop in at the beginning when you open a policy?
It all has to do with your insurability, how much death benefit the insurance company is willing to give you. So we're all about the same age, I assume. Um, we could get 30 times our annual income in death benefit. At that point, we would be fully insured at about 30 times our gross income. Now, at that point, we could insure a spouse, we could insure children, we could insure business partners, we could insure anyone that we have what's called an insurable interest in. We'd insure our parents.
Oh, that's an interesting idea. Okay.
Yeah.
Now, okay, so how would that work? So, like, for example, I've heard of this term of key man insurance for,
Yep. You
so,
use the same justification as key man insurance. Key man insurance is typically a term product, which is different than the dividend paying whole life we're talking about. But yes, you use the same concept of insurability, where if Aziz and I were business partners, and Aziz was 50% partner, generated 50% of the revenue, and we were $1 million company, then I could probably take out a $5 million policy on Aziz because I could insure we're going to be partners for the next 10 years. So I could insure his $500,000 for 10 years.
very interesting. So,
Mhm. Same concept, but we would just use a different product. We'd use dividend paying whole life, properly structured.
one, I don't know, we're just, what's the word? Just kind of like
Spitballing,
spitballing. That's it.
rapid fire. Let's go.
So, what about, so in all the examples we've talked about borrowing ourselves from
Yeah.
our own account. Can we lend?
Oh,
Can we
yeah.
become other people's banks and
Hell
make them pay
yeah.
us instead? Okay.
Yeah, VC.
Oh,
It's just VC. Yeah, absolutely.
Interesting. Okay.
Yeah. Okay. So
And
here's
can
a
you
loan that
charge
I
different
made.
rates? Can you charge 10%
Yeah,
instead of?
anything you want. Yeah. Yeah. There's no terms. It's a private loan between you and the insurance company. Nobody knows about it. It doesn't count against your debt to income ratio. You don't have to report it to anyone. Now, if you charge someone interest above and beyond what your insurance company is charging you, then you have to claim the margin as income for IRS purposes. But yeah, okay, here's an example. My buddy went and bought like a $30,000 Jeep Grand Cherokee. Okay. And had like terrible credit. And so he walked with a 24% note. Yeah. So I had enough money in my insurance policy to refinance the car for him. And I said, hey, Zach, I know they stuck the screws to you, dude, on that 24% note. I tell you what, if you promise to repay me on time, I'd be willing to finance it at 15% for you. And he was like, really? Oh, dude, that'd be so awesome. And I was like, all right, man, let's go. Let's draw it up. Yeah, private contract. Zach and I have a piece of paper where I have his car financed. I have the title to his car. I just went and bought the whole note from the bank, paid it off. And now Zach's paying me at 15%, thinking he's just, I hope he doesn't watch this. He's thinking he's just getting a hell of a deal.
Well, he
And,
is. He is getting.
Well,
he
yeah,
is.
compared to
He is. He's saving
24%.
so much money. Right.
That's awesome. Everyone wins.
Yeah. So you can absolutely do private loans. One of my buddies down in Texas, a different guy, it's kind of like a lease to own situation with his tenants. Yeah. He finances houses for people that couldn't get traditional loans through banks. And he does that through his infinite banking policy. If they default on the loan, then he just evicts them and it's like 100% profit.
Oh,
Sheesh.
One of my other buddies in Chicago has a business plan put together that he's working on accumulating capital to execute, of buying luxury vehicles and renting them out over Turo or whatever the Airbnb is for cars. I think it's Turo.
Yeah, it is true. Yep.
Yeah. Yeah. So that's his plan, is accumulate enough capital to finance cars, which will cash flow on the rental, and then use the cash flows to pay back his policy and start other policies whenever his policy can no longer hold the capital from that cash flow. You can own more than one policy.
Okay.
Yeah. I heard Nelson Nash passed away with something like 30 to 40 policies in place. Some were on him, some were on family members, but yeah, he owned about 30 insurance policies whenever he passed. Passed away 2 years ago.
Now, what is the normal, like if I say I'm starting a policy now, what would be the cost to me to start that policy?
Yeah, I just designed a policy the other day for $200 a month. And that was about the lowest I've ever gone on a policy. Then I have one client that does $200,000 a year.
Oh, wow.
And so you could do anything in between.
So for something like a $200 a month, what is the cap that gives you on your policy?
I designed that one at $3,600 cap.
Okay.
So he could put an additional $1,200 of cash flow into that policy above and beyond his monthly payment. I always design them with a little bit of room like that.
Okay. Now, let's say you have a policy and you're getting close to your cap. Can you restructure it, or do you have to start a whole new policy if you want to increase it?
New policy. Yeah.
New policy.
If income increases and cash flows increase, there is a cap on that policy, and that's the IRS ceiling. That's the modified endowment contract. If you exceed that cap, then you lose the tax favorable status. Your growth is then taxable and your death benefit becomes taxable.
So you have to start a new policy.
Mm-hmm. Yep.
Now, do the payments ever end once you reach the cap, or?
They can. Yeah. You can take a reduced paid up benefit. You could stop payments if you needed to. Typically for our age, payments would stop at either 75 or 95, depending on the design of the policy. But we could do anything from 7 payments, 10 payments, 20 payments. Shoot, you pick a number. You want 23 payments because it's Michael Jordan's number. I could design a policy to take 23 payments and then be done. It's whatever. Can't do less than 7. If you go less than 7, then you violate that modified endowment contract rule. But as long as you do at least 7 payments, you could be done, or you could pay it to age 95.
Okay. And you can have the cap be extremely, let's say you want $1 million cap, but you don't want to have a high monthly payment. Is that doable?
It is, but it makes the policy terribly inefficient.
Okay.
Yeah. Yeah. Be hard to explain without an actual illustration of the numbers in front of me. Okay, here's an analogy. You know how Lamborghinis get better gas mileage at like 130 miles an hour than they do at 30 miles an hour?
I did not know that, but now I do.
Okay. It's because that Lamborghini is designed to go like 200 miles an hour. So 130, it's just warming up. Like that's cruising speed, right?
Okay.
If it's going 30, it is just swallowing gasoline, right?
Okay.
So it's the same thing with these insurance policies. If we design these insurance policies to run like a Ferrari, then you need to make sure that you get that money in there and fill that space, right? So we don't want to have a $200 monthly payment and $1 million cap, because then we'll never see any type of ROI. All of that $200 is going to be eaten up by the cost of insurance on that policy, right? So what we want to do is, for a first policy, design something that's a little bit uncomfortable. That you're stretching yourself kind of to make these payments, but it's still well within the realm of possibility.
Now, you were mentioning that the money would be eaten up by the cost of insurance.
Mhm.
Can you explain that for our listeners?
Yeah, absolutely. So there is a cost of insurance to this. That death benefit has a present day cost, right? There's also operational costs. The president of the company collects a salary. The actuaries are paid really well because they're the geniuses behind the calculations. The customer service team at home office, they have a building, they keep the lights on, etc. So all of these contribute to the actual cost of the policy, right? Now, in dividend paying whole life, the cost of the policy is front end loaded, like in the first 4 years. So typically you'll see negative equity growth relative to premiums your first 4 years. So if I put in a $10,000 premium, year one, I might only have $6,000 of cash value. Year two, I'm going to get a little more positive. Year 3, 4, a little more positive. Finally, year 5, my $10,000 premium will turn into $10,000 of cash value growth. And then by about year 8, 9, 10, 11, depending on the age of the client and the policy design, 8, 9, 10, 11, you'll see your gross, your net premiums equal your net cash value. So year 10, you'd have $100,000 paid in and $100,000 available in cash value.
Okay. So basically that's like for example, if you have an ETF in the stocks game, the management fee that you would be charged for that ETF is the same thing, equivalent to what you're talking about here for the term life insurance.
Right.
It's just the cost of maintaining this policy.
Yep.
And then you said
the cost of acquisition.
Right. And then that reduces after 4 years, or completely goes away after that 4-year period.
Your year over year net positive, typically year 5 or 6.
And it goes away completely.
Yeah.
Oh, okay.
Yeah. There still is a very small cost of insurance ongoing, but all the administrative stuff is front end loaded. The commissions for me, the insurance agent, are year one commissions. Then there's a very small trail ongoing in terms of commission for me. But yeah, the majority of the costs are front end loaded.
Very interesting. Well, Brad, is there anything else that you think we might have left out, or anything else that you wanted to share with our audience before? One thing occurs to me, maybe you could talk a little bit about what that first meeting is. Someone picks up the phone, they listen to this podcast, and they say, I want to talk to Brad.
Yeah.
What would that first call go? What are some of the topics you normally cover on those calls?
Yeah. So I just want to get a good understanding of how much you know. And then I need to steer you to some resources so that you can round out your understanding. This relationship between me and my clients is more like a coach, right? I'm going to coach you through this process, hopefully until the good Lord calls me home, right? Hopefully I'll be around another 40 years, 50 years, and I can help walk you through this entire process for the rest of our lives together, right? But if something were to happen to me 3 days from now, I need you to know how to utilize this asset. Because I truly believe that dividend paying whole life is the greatest asset you could ever own. So on the first call, I'm going to figure out where your knowledge is at and what's the quickest way for me to get you from point A to point B. Point B being pretty efficient, pretty proficient, knowing what you're doing with these policies. Somewhere along that road, whenever it really clicks and the light bulbs go off for you and you're like, this is how I'm going to use it. I'm so convicted. I need to get this started yesterday, blah, blah, blah. At that point, we'll put in an application to the insurance company. And then we'll just do continuing education from there on out. I talk to my clients. My best clients I talk to once or twice a week. We're swapping podcasts, blogs, talking about uses of our policies, talking about the loans we made that are looking rough and maybe aren't going to pay out, and blah, blah, blah. So yeah, the first call though, figuring out where you're at, pointing you to some resources and trying to get you more and more proficient.
Beautiful.
This whole concept, Nelson always said, it's caught, not taught. And I don't work with a client until I know that light bulb has gone off. Because if I force someone into this, 3 years from now, they're going to wonder why they're paying a $10,000 check to this insurance company. You know what I mean? And they're going to cancel their policy and they're going to walk away from it. And I don't want that. I want my clients to have a full understanding of this before we ever even pull the trigger on an application to the company. Maybe not a full, that's a little bit of an exaggeration, but they definitely have to see the long-term worth in this. You have to think long-term in order to do this.
Very cool.
Yeah.
Well, please, do you have any other kind of last words to share with our audience, or any resources you'd like to share for them?
Yeah. My mentor and one of my good friends, Ryan Griggs, have a podcast on YouTube called Banking with Life. Both of them are incredible practitioners. Listen, I'd love to do business with your listeners, but there's no one better in the United States than James Nethery. And he has a fantastic podcast called Banking with Life. He and Ryan Griggs co-host that. Ryan Griggs has a Medium blog that is incredible. And I post about it all the time on both Facebook and Instagram. On Facebook, I'm at Brad KRS. And on Instagram, I'm Local Liberty Dad.
Awesome. Yeah. And are those the best ways that people can get in contact with you if they want to work with you or get more information?
Yeah. Y'all feel free to call or text me. My work cell is 325-203-6946, or you can reach out to me on Facebook or Instagram.
Awesome.
Excellent.
Yeah.
Well, Brad, second time's a charm. Let's hope it recorded this time. And thank you so much for your time, man. This was awesome. Again, I feel like I still learned even more this time, really. So thank you.
Yeah, no, it was very informative.
Listen, my first one was haunting me. I thought I did a terrible job. I thought that y'all didn't post it because I was like the worst podcast guest ever. Thank God it was audio problems. But yeah, I thought about this until you messaged me the other day. It had been going on in the back of my head, like, how can I present this more clearly and concisely? And hopefully I achieved that. Hopefully people see a practical use for this in their lives and want to take the next step on learning. So yeah, reach out to me. Go get Nelson Nash's book, Becoming Your Own Banker. That's probably the best answer to what's the first step. Go get Nelson Nash's book, Becoming Your Own Banker, 5th edition, and read that and then reach out to me.
Awesome. Thank you again, Brad. And you definitely did awesome. I think this is the most informative session I've had regarding the topic. So, and even counting the last time, this was even more informative than that.
Cool.
So you did an awesome job, and we thank you.
Yeah. There's a lot of noise out there. Listen, there's a lot of little TikTok kids out there right now talking about infinite banking. And guys, you want a authorized infinite banking concepts practitioner, authorized by the Nelson Nash Institute. They're going to do it right. They're going to set you up a policy that's going to last. You can go get someone off TikTok to write you a policy, but it's not going to have a solid foundation. It might not even be the right product with the right company. So definitely find you an authorized IBC practitioner. I'd love to work with you.
Awesome. Thank you so much.
Thank you so much. Yeah.
Yeah, guys. Appreciate it.